So, let's talk about something that's at the very heart of honest accounting, making sure the numbers on the books actually reflect what things are worth in the real world. We're diving into the impairment of assets. Okay, picture this. A company spends a cool $50 million on a brand new factory. That number goes right onto their balance sheet. But what happened a few years down the line? Maybe a new technology comes out that makes this factory kind of obsolete. Or maybe the economy takes a nosedive and nobody's buying what they make anymore. Is it really still a $50 million asset? Probably not, right? And that's the exact problem we're here to solve. Because, when the value of a company's assets is puffed up, it creates this dangerously misleading picture for everybody. Investors might pour money in, thinking the company is stronger than it is. Banks could lend money based on assets that just aren't worth what they claim. It's basically a house of cards, and it all depends on those numbers being legit. And that's where this really powerful accounting rule comes into play. IAS 36, Impairment of Assets. Its whole purpose is actually pretty simple, but it's absolutely critical. It's there to make sure a company's assets are never ever listed for more than what the company could realistically get back from them. So here's our game plan. We're going to break down the impairment test itself. Then we'll look at what actually triggers a test, what you do when you find a loss, and finally, how you handle it when assets work together as a team. All right, let's get right into it. The impairment test. This is the nuts and bolts of figuring out if an asset's value needs to be written down. The whole thing boils down to a really simple comparison. On one hand, you have the carrying amount. That's just the value of the asset sitting on the balance sheet. And on the other hand, you have the recoverable amount, which is what it's actually worth today. If that book value is higher than its real-world value, boom, you've got an impairment. So what in the world is this recoverable amount? Think of it as the true economic firepower of an asset. It's the total value the company can squeeze out of it, one way or another, either by using it for years to come or just by selling it off. Now, to figure that out, you have two roads you can go down. The first is what we call fair value less cost to sell. It's pretty much what it sounds like. What could you sell it for today, minus any fees like sales commissions? The second road is value in use. This one's all about the future. It asks, what's the value, right now, of all the money this asset is going to generate over the rest of its useful life? And here is the absolute key. The company gets to pick the higher of those two numbers. The rule doesn't force a pessimistic view. The recoverable amount is the higher of what you could sell it for and what you could earn from it. It's the most optimistic but still realistic view of what that asset is worth. Let's walk through this, because this makes it super clear. Look at asset A. It's on the books for $100K. We compare its two values, and the higher one is $120K. Since that's more than the carrying amount, we're good. No impairment. Now, asset B. It's on the books for $150K. The higher of its two values is $130K. Uh-oh. The book value is $20,000 higher than its recoverable amount, so we have to record a $20,000 impairment loss. And it's the exact same logic for asset C. See, it's pretty straightforward when you see the numbers. Okay, so we know how to do the test. But when do you actually do it? Companies don't just run this test on every single asset every year. Instead, they look for triggers, basically red flags that shout, hey, maybe you should check the value of this thing. Some of these red flags come from the outside world. Like if the market price for an asset like yours suddenly falls off a cliff, that's a huge one. Or big negative shifts in technology, the economy, or even the law. Even something like rising interest rates can be a trigger because that makes all those future cash flows for the value in use calculation worth less today. Then you've got clues from inside the company itself. Is a machine physically busted or just plain old? Is the company planning a major restructuring that's going to leave a factory sitting idle? Or are the internal reports just showing that an asset isn't pulling its weight like everyone thought it would? All of these are signals to go and run the impairment test. And the rules on this are crystal clear. Seeing one of these triggers isn't a friendly suggestion to take a peek. It means an impairment review is absolutely mandatory. You have to do the math. So let's say you've run the test, you've found an impairment loss. What happens now? How does this actually hit the books and affect the company's financial story? The impact is immediate, and it's big. That impairment loss gets treated as an expense right now. It goes straight to the profit or loss statement, which means it directly shrinks the company's net profit for the year. It's a public acknowledgement that an asset just wasn't worth what they said it was. But here's an interesting twist. What if things turn around? The economy bounces back, or a new use is found for that old factory. Is that write-down permanent, or can you get it back? And the short answer is yes, you can reverse it. If there's good evidence that an asset's value has bounced back, the company can write the value back up, and that actually gets recorded as income. But, and these are huge buts, there are two big rules. First, you can only reverse the value back up to what it would have been with normal depreciation if the impairment never happened. You can't just make up a new higher value. And the second rule is a big one. An impairment loss on something called goodwill can never, ever, ever be reversed. Once goodwill is written down, it's gone for good. Now, so far, we've been talking about single assets, one by one, but life's not always that neat, is it? In the real world, assets often have to work together as a team to make any money at all. And that brings us to this concept of a cash-generating unit, or a CGU. The perfect example is a single restaurant in a big chain. You can't really measure the future cash flows from just the pizza oven, right? The oven, the chairs, the building, they all work together as one unit to bring in cash. That whole restaurant, that's the CGU. So what happens if that entire restaurant gets impaired? How do you split up the loss? Well, IAS 36 gives you a clear two-step playbook. Step 1, you immediately wipe out any goodwill that's attached to that restaurant. If you've zeroed out the goodwill and there's still more loss to account for, then you move to step 2. You spread the rest of the loss across all the other assets in the unit, like the ovens and tables, based on their value. So if you only remember one thing from all of this, let it be this. Asset impairment is the process that forces a company's balance sheet to tell the truth about today's economic reality, not just cling to some historical number from years ago. It's a fundamental reality check for financial reporting. And I'll leave you with this final thought to chew on. Next time you look at a company's balance sheet, ask yourself, what hidden bombs might be ticking away in there on a balance sheet that hasn't been properly tested for impairment? It's a question every single investor should be asking.